After the last few years, it would be understandable to think that real estate investment trust, or REITs in short, are a poor place to invest your money. Might as well just stick to an index fund. But what if we told you that after the amazing performance of the broad-based indexes and the poor performance of REITs, the latter is more likely to outperform the former going forward? We think that's exactly what will happen. We think REITs are likely to outperform the broader market and big tech stocks such as the Magnificent Seven over the next few years. Let's discuss why, and afterwards we'll also discuss 3 opportunistic REITs that we are buying at the moment. Hey, this is Yussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to explain to you why we think that the S&P 500 is a bad investment right now and why we expect REITs to do far better going forward. But before I get into it, can you please show your appreciation by clicking the like button, subscribing to the channel? That helps us a lot to keep on growing. Thanks so much in advance. So why is the S&P 500 a bad investment at the moment? History doesn't repeat itself, but it sometimes does rhythm. Right now, the S&P 500 has rarely been as highly valued throughout its history. Its valuation is so rich today that it's quite close to the peak of the dot-com bubble in the late 90s when it traded at 24 times forward earnings. In comparison, it's today trading at 22 times forward earnings, which is one of the highest multiples in modern history. In fact, as you can see in the table above the chart that I put on the screen, the current market is more richly valued than its 30-year average in virtually every measurable way. By earnings, cash flow, dividend yield, or book value, today's stock market is pricier than it has been for most of its history. And what has the forward performance typically been for the S&P 500 when the index was valued at such high levels in the past? Well, it's been very poor, and I'll put another chart now on the screen where you'll see this. The chart on the left shows the forward 1-year returns when the S&P 500 has been at a similar PE ratio in the past, and the chart on the right shows the forward 5-year returns, and in both cases they've been basically 0%. The relatively high valuation for the stock market is primarily because of the richly valued tech stock that are within the S&P 500. Now, we don't doubt the innovativeness or growth potential of these fantastic tech companies like Nvidia, Google, Tesla, and so on, but you need to know that there has been many innovative, high-growth public tech companies throughout modern history, and as they become overvalued, they've ended up becoming poor investments in the following years. I'm not a tech analyst, and so I cannot tell you with high confidence whether these tech companies are richly valued or not right now, but given how much they've surged already and the gravitational pull of valuations towards their long-term averages, we will much rather bet on something else that's trading at a below-average valuation, offering better future return potential and margin of safety. And what's out there that's currently trading at below-average valuation, and that's the real estate investment trust sector. Right now, the REIT index is priced quite literally at its lowest valuation relative to the S&P 500 in over a decade. It's the lowest valuation since the Great Financial Crisis. The main reason for this historically large discount are concerns over the rising interest rates and how those will impact REITs, but as we've explained in many previous videos, those concerns have been completely overblown. REIT leverage is today at an all-time low with the average LTV at just around 35%, which is very conservative for REITs. Most of that debt has a fixed rate and long debt maturities that are well staggered. And on top of that, it's also important to remember that interest rates only surged because inflation was hot, and inflation benefits real estate. It leads to higher property replacement costs, higher rents, and so REITs are more than able to make up with the higher rents for the higher interest expense that will only impact them gradually over time as their debt matures and they refinance it. And this explains why REIT cash flows have kept rising in 2022, 2023, 2024, and will likely again in 2025, even despite having seen their share prices drop substantially. And so how have REITs performed historically on a forward basis when they've been priced at such a steep discount relative to the S&P 500? And the answer is really well. They've significantly outperformed the S&P 500. Over the last 20 years, when REITs have been this discounted relative to the S&P 500, they've outperformed during the next 1 year, 2 year, and 3 year time periods. And we can now also look at a few real-life examples of the past. Here's how REITs performed relative to the S&P 500 in the 3-year periods from 2004 to 2006. REITs nearly doubled investors' money in just 3 years, whereas the S&P 500 only delivered 30% returns. And here's how REITs performed relative to the S&P 500 coming out of the Great Financial Crisis, which is when they were last time trading at such cheap valuations relative to the broader market. And again, you'll see there that REITs massively outperformed in the recovery. Our prediction is that as rent growth now accelerates in most property sectors due to the new supply coming down significantly, and the Fed resumes interest rates cuts around the same time in 2026, we'll see REITs regain a much better market sentiment, and this will be the beginning of their recovery, and this could lead to significant outperformance relative to the S&P 500, which is already overvalued by most standards. But what REITs should you buy? And this is a difficult question because there are so many REITs today trading below their long-term average valuations. First up, I want to discuss Alexandria Real Estate, symbol ARE, which is an owner-developer of top-tier, state-of-the-art life science facilities, typically located adjacent or in close proximity to top research universities like the MIT or Stanford. This is what we would typically describe as a blue-chip REIT because it owns Class A assets that enjoy attractive long-term growth prospects. It has a fortress balance sheet with a BBB+ investment grade rating, very long debt maturities in excess of 10 years. These are some of the longest debt maturities in the entire REIT sector. It also has significant liquidity to take on new investment projects, a relatively low dividend payout ratio to retain a lot of cash flow to reinvest in growth again. The management has an amazing track record, again, one of the best in the REIT sector. They have even outperformed Warren Buffett's Berkshire Hathaway since they went public. And so, again, they really check all the boxes. Yet they are today priced at a historically low valuation multiple that's on par with the great financial crisis if you adjust for their today's better balance sheet and even higher quality portfolio. I think they're actually even slightly cheaper than during the great financial crisis at the moment. And this is entirely because of, one, the surge in interest rate, which has depressed all REITs, and then secondly, the oversupply that's currently in the life science market. You need to understand here that the pandemic greatly boosted the investment in new biotech research and development, and so this then led to a lot of developers starting new construction projects. And then secondly, a lot of office landlords also tried to then convert their empty office buildings into life science buildings, and all of that has now led to historically large supply hitting the market in 2025, also in 2024, and will continue in 2026. And so this is impacting the rent growth of the properties of Alexandria now in the near term. However, we think that this is just a temporary issue. Now the supply is already starting to come down significantly because of the high construction cost, the high interest rates. The office sector is also starting to see its fundamentals improve. The demand is slightly recovering, and so we'll see less conversions in the future. And so we think that the market is simply making the mistake here of focusing too much on the relatively poor short-term prospects and forgetting about the bigger picture. The market is quick to extrapolate recent trends far into the future, but fails to understand that real estate is cyclical. You have cycles of oversupply, those are commonly followed by cycles of undersupply, and we think that we are going into that, and as rent growth accelerates, we'll see the valuation strongly recover in the case of Alexandria because it's such a high quality REIT. It really comes down to the fact that the stock is down over 50% because of poor near-term prospects, but high-quality real estate should be priced based on decades of expected future cash flow, and therefore the impact of 1 or 2 years of relatively poor performance really shouldn't have such a big impact on the valuation of the company. Again, this is simply because most stock investors are so short-term focused and they are losing track of the bigger picture. And so we think that this is a great investment opportunity for long-term oriented real estate investors who can see that these properties are today undervalued by an excessively short-term focused market. Then the second REIT I want to discuss is EastGroup Properties. This is an industrial REIT that focuses on urban locations, last mile locations of rapidly growing Sunbelt markets for the most part. And so these properties have historically done really well. It's pretty much the same story of Alexandria. Amazing balance sheet, amazing track record, assets that enjoy very attractive long-term growth prospects. But again, they're impacted by short-term oversupply in their markets. It's slowing down their rent growth. While in the case of EastGroup Properties, they're not as heavily discounted as Alexandria because the demand is still so strong that they're still able to keep growing their rents. And in many cases, their legacy leases have been below market because their lease rates were inferior to the market rent growth. And so this is providing margin of safety. But also in the case of EastGroup Properties, their valuation has dropped significantly even then, and they are currently priced on par as during the pandemic when their share price first crashed. And again, we think that it's a great opportunity for long-term oriented investors. This is a REIT that has massively outperformed the market over the long run, and we expect them to return to this track of outperformance very soon. But then if you have an even higher risk tolerance like I do, there are a lot of smaller and lesser known small cap REITs that are even more heavily discounted than the two that I just described, because those are very large blue chip type REITs. But it's interesting to see that even those are discounted. But once again, if you want to get even larger discount, you can get that in the REIT sector. There are companies like Armada Hoffler Properties. It's a small cap REIT that owns very high quality assets in my opinion, but has a bit more leverage, and it's today trading at a very low valuation. Its dividend yields about 8%. We think that has about 50% upside to fair value. But when you're investing in these small REITs, you need to be very selective. There are a lot of landmines there, a lot of companies that are over leveraged or poorly managed. You need to be very selective, and that's what we're doing at High Yield Landlord. Our portfolio today holds about 20 such REITs, but there are over 1,000 REITs worldwide. We are very selective. We are commonly interviewing the management teams, and if you want to access our full portfolio, you can join us for a 2-week free trial. This will give you immediate access to my full portfolio holdings, all my transactions in real time, my exclusive REIT CEO interviews, and all my research that I've produced to date. It will be the first link in the description of this video. Otherwise, once more, if you could please click the like button, subscribe to the channel, that will help me a lot. Let me know also in the comment section below what you think of the S&P 500 right now. Perhaps you're more bullish than me. Let me know your thoughts. See you at my next one. Bye bye.